Hello, everyone. It's my pleasure to welcome you to the Patrick Delhougne show. And today we have a very, very special event for you with my dear friend, Shan Saeed from Kuala Lumpur, one of the chief economists of the largest brokerage house, and also a friend from the Chicago Booth MBA. We've known each other through networking, and he's someone that I highly respect in the field of macroeconomic and global understanding. I wanted to invite Shan to talk about a couple of things, more importantly, the geopolitical risks and market shenanigans that we have experienced recently. Talk a little bit about Asia, Europe, and the US as well. And the great news is that we will start a little bit of a series, so you will have a chance to meet with Sean and I on a couple of other programs, because we will try to cover valuation, the bond market, real estate in a much more detailed manner. John, welcome to the program. Absolutely delighted to have you.
Thank you, Patrick. Bonjour from Kuala Lumpur. And it's my great honor that I am on your YouTube channel. We have been discussing it. I'm very privileged that I know you for the last 5 years. And what I like about you is that you are very straightforward. You are blunt, you're outspoken. And I like people who are straightforward. I don't believe in platter charm of couture. I don't believe in sugar-coated stuff. So once people are, straightforward with me, they're open. I am very, for me, it's a comfort tip. So it's great to be here. And I am ready for your question.
Great. I feel the same, and the purpose of this program is obviously to try to provide an overview and a deep understanding of market and the macroeconomic challenges that the market is facing without sugarcoating anything. So you hit it on the nail there. So listen, I wanted to talk a little bit about the bond market and risk with you, especially following the beginning of the war in Israel. I think that this has really changed and impacted the global economy and has certainly had an impact on oil and valuation. So wanted to get your perspective on the geopolitical risk, and more importantly, also on the pressure that the bond market has experienced recently.
Thank you, Patrick. Very important question. All the major investment bankers, central bankers, influencers, policymakers, people from sovereign funds, pension funds, endowments, everybody is looking at the debt market. Since last year, we have seen the rising interest rate. And as you know, rising interest rates have inverse correlation with the bond market. And we have seen bond market under a lot of pressure. And we have seen what happened last year on 26 September. When Bank of England pushed out those investors who were trying to bet against the UK bond market. So I think bond market is clearly sending a signal that I had shared last year when I was invited on 19th October at SIDC, which is the training of Securities Commission Malaysia, that the markets will remain under pressure. Inflation will remain high because the yield curve in the debt market is going up. And last month, the 10-year yield was at 4.44. And now when I was checking tradingeconomics.com, it was 4.86. So it has gone up by 10%. Many people were saying that, the interest rates are, will go up and inflation is coming down. I don't agree. Inflation will continue to stay high. It will remain stubborn. It will remain pugnacious. Central banks are in a very complex situation, especially the Fed, the ECB, Bank of England, and Bank of Japan. And Fed has made a lot of mistakes in the last 17 years. I have been following Fed since 2006, and I personally witnessed to what happened to Bear Stearns on 18th March 2008, Tuesday. Bear Stearns went down. I was in Chicago. It collapsed in front of me. 15th September 2008, Monday, first day of my lecture. I was in Chicago when Lehman Brothers went down. So I think Fed has committed a lot of mistakes, and markets have started to realize that Fed is not on the right path. I still remember I was reading Economist magazine 2050. The title of that article was Funny Numbers. Page 66, October 24th to October 31st. It says in first paragraph, third line, markets are not believing what Janet Yellen was saying. And since last year, Janet Yellen and Jerome Powell is saying that inflation is temporary, it will go away since 2021, then the inflation remains elevated and it remains pugnacious. So right now, the bond market is sending a signal to everyone, to those sophisticated and smart and well-informed investors like you and many others who are listening to us, that inflation will remain high. Global economy will not recover before 2026, 2027. And now you have a new variable, that is geopolitical risk. So last week, you have read in Financial Times, investors are concerned about two things. One is rising interest rates, and number two is the geopolitical uncertainty, geopolitical conflict that is happening in the market right now. And it's making a huge impact across all asset classes. Look at gold. From October 7th, gold has gone up by 8%. Look at the oil market. I have been on CNBC and on Bloomberg in Dubai, and I have been saying that oil market will be trading between $83 and $127 per barrel. And last month, it had $97 per barrel. And since 26 June, as of today, oil is up 20%. So the geopolitical risk is creating a lot of uncertainty. Investors are nervous, and we are back to that situation of 1970s when we received oil shock in 1973, 1974, when oil prices went up from $3 per barrel to $12 per barrel, almost 300% increase. So I think markets will remain under a lot of pressure. I don't see the markets recovering. The markets have been on QE, easy money for number of times, and now the markets are feeling the pinch because they are squeezing liquidity from the market. But again, in our April 22 newsletter, we have already shared with our valued and sophisticated investors that we started off with stagflation, we started off with rising interest rate, and then we will have QE spike. So eventually, Fed, ECB, and Bank of England, they will cut interest rate. And historically speaking, whenever you have elections, we have witnessed on 2019, Fed has always cut interest rate. And if you recall, in October 2018, markets, investors lost $5 trillion. And from 1st October till 24th December 2018, equity markets almost 90%, almost it was in the bear market. And then Jerome Powell, he threw in the towel and said, I'm not raising rates, I am cutting rates. So in 2019, he started cutting rates. I think we are back to that situation. We will be witnessing QE5. The equity markets will go up once the Fed will give the signal to the market that we are not raising interest rates. ECB has already sent the signal. They have remained status quo. We will have this meeting day after tomorrow, and on 1st of November, I see status quo from the Fed. I don't see the interest rates going up this round.
Yeah, I totally agree with you. I mean, I think that the Fed, Jerome Powell, has been relying on quantitative easing and obviously trying to raise interest rate with the purpose to curb inflation. Unfortunately, that has not worked very well. And I think the reason it has not worked very well is you look at core inflationary indicator, we are now back at 4.8, 4.9. The last data, if you take out energy and you take away the food sector, it's back to 4.2%. But it is clear that the extraordinary increases that we have experienced in the market, from 0 to now well above 5%, and also the reverse of the yield curve. I mean, this is an incredible phenomenon where the 2 years, the 3 months is, higher than the 10-year. And we've seen the 10-year coming down a little bit, but it was for a couple of days about 5%. And that was an historical moment 2 weeks ago. So I think that Jerome Powell next week is not going to increase rate. He will continue to pause, and we're going to experience a pause until the end of the year. There is a possibility that in 2024, we are going to see a rate continue to increase because I don't think that they will be able to contain inflationary pressure. And a lot of that depends on what is going to happen in Iran. And, I would love to get your point of view there. But if the conflict escalates, and I pray that it will not escalate, I hope that the conflict will not escalate into a World War III, so to speak, and a conflict with Iran and then other Arab countries, then, there are some politicians here in the U.S. who are talking about destroying the oil capability of Iran and therefore dramatically decreasing oil output production. If you go back to what Goldman Sachs analysts and Morgan Stanley said, I think it was 2 weeks ago, this concurs very much with what you were saying. That price is going to go up to $125, $127 a barrel. There are some analysts who are even talking about, going up to $150 a barrel. So you can imagine the impact that this would have on inflation. So to go back on monetary policy, I think a big problem that we have had in the U.S. is that we continue to print an extraordinary amount of money. And if you look at the quantity of M2, the velocity of money has been reduced to 0.2. So, normally the velocity should be around 10, 11, 12%. And we were very, very low. So there is a shortage of liquidity, around $2.7 trillion missing in the market. And you have a huge problem with banks not having the liquidity to continue to finance. So the point that you made, I think, is a very important point about the potential escalation of the war and of the conflict. What are people in Malaysia, what are people in Asia saying about the escalation of the conflict and the impact on oil prices?
Yes, Patrick, you have raised a good point. Let me go back to your point on Iran. And you were talking about the geopolitical risk. We started talking about in 2016, 2017 about geopolitical. And with my interview on 16th October with CNBC Indonesia and with CNBC Arabia and Dubai, I mentioned about two scenarios with assigned probability. If this conflict remains for next 1 month, oil prices will be trading between $95 and $100 per barrel. And if this conflict goes, and the probability is around 50 to 60%, and if this conflict goes beyond 1 month, at least for 2 months, then we will have the same scenario what we witnessed in 2008 on 11 July, when oil was trading at $147 per barrel. And I still remember, I was sitting with my Nobel laureate, Professor Robert Fogier, over lunchtime. I said, one of the analysts at Goldman Sachs said, oil prices will touch $200 per barrel. And I said, Professor, it's not possible at that time in 2008. I said, it could be $97 per barrel. He said, go on CNN and counter his argument. So I posted my comments on CNN. This is 11 July 2008. Oil prices will be trading at $97 per barrel on 31st December 2008. And on 31st December, oil was trading at $34 per barrel. And on 31st December 2009, oil was trading at $79.80, almost double of 2008. So I think I have a side probability if this goes on for 2 months. We will witness what Goldman Sachs and, as you pointed out, Morgan Stanley analysts are saying. We will witness oil prices hovering between $125 and $147 per barrel. So things are very, very complex. They're very unpredictable. People in Asia, they're extremely worried with this geopolitical situation happening in Middle East. And God forbid it doesn't go out of hand. There are a lot of players involved. US is a major player. They're trying to create a ceasefire between all the forces in order to continue, because humanitarian crisis is going, huge. So I think good senses will prevail and this war will stop, because nobody wins in the war. Everybody loses.
No, but it's not. Sam, the issue is a lot of people, even I would say the Israeli as well, do not want this war. The issue is when a war starts and you have different group attacking each other, you really don't know how it can escalate. I mean, right now in Gaza, they started 2 days ago, the ground maneuver. They're going house to house. They're trying to attack all the tunnel. It is also clear that this will be extremely slow. This will be a protracted war. So the scenario that, everything will be stopped in a couple of weeks, the general of the Israeli army, of the IDF, came and said that it will not be a couple of weeks, it will be a couple of months. So to the point that you were mentioning, and the post that you put on social media about 1970 and the fact that we risk getting back to an oil shock and potentially stagflation, do you really think that we could experience such a dramatic scenario going back to basically a mega oil crisis from the 70s, oil crisis in a period of stagflation?
Yes, Patrick, this is one of my favorite topics nowadays, because this is September 2020. One of my best friends, we used to play hockey together. I was a captain of the St. Paul's school hockey team. He was the captain of St. Patrick's school hockey team way back in Pakistan. He invited to a webinar organized by the Stanford GSP alumni. And one of the alumni, he mentioned about that we are heading back to the same scenario of 1970s. So he said about the COVID and the oil shock at that time. If you recall, Monday, 20th April 2020, oil was trading at minus $37.63. And a lot of people were saying, oil is going down and, oil players would collapse, but it did not happen. By 5th June 2020, oil was trading at $42 per barrel. We put that thing in our November 2020 newsletter. Advanced economies will face stagflation. And right now, we are in the same situation of stagflation, where you have high inflation and lower growth. Right now, when I speak to you, 60% of the global economy is in stagflation, 25% is in recession, and 10% is on the verge of sovereign debt risk. So this scenario will remain for the next 3 to 4 years or even longer. I'm very conservative when I was speaking at Securities Commission on 19th October last year, that the global economy will recover by 26-27. I think it might go even beyond 26-27. It might recover in 29-30. And what Fed is doing, Patrick, I wanted to share with you. I follow Milton Friedman, one of the greatest Nobel laureates of the modern era, wrote this book in 1990, Money Mischief, the episode of monetary history. And he mentioned in chapter 8 how Fed is going to create prices in the form of inflation. The causes and cure of inflation, chapter number 8.
Yeah, I read that chapter. Yeah. And we've done it. We've actually created the inflation by printing so much money.
Yes. So I share with my friends and with people in my networking that I have read the playbook. I know the script. So what is happening in the market right now is nothing new, because those sophisticated and smart and well-informed investors who follow Joy, IQI, we are just a real estate brokerage, the biggest in Malaysia, one of the top in Asia Pacific, that whatever we share in our newsletter, it is based on critical reasoning. It is based on solid facts and figures, and it is based on substance. Because nobody has got time to read about Cinderella stories and James Bond stories and tabloid stories. Investors, they don't have time. They want, if you share any data, you have to make an economic and financial sense out of that. So that those investors who have got huge funds, they need to allocate the funds according to where the markets are going, according to where the asset classes are can take the pressure of, higher interest rates. So I think we have been spot on. This year, last year, we set 7 risks to the global economy. Out of 7, we have already hit 5. So that takes 71% right on the dot. And we continue to engage our investors on what is happening in the global economy. So coming back to your question, yes, stagflation will remain high, and many economies will either have zero growth, negative growth, and very few economies will have positive growth, including ASEAN, GCC, and Africa.
Yeah, I mean, this is, a very interesting global perspective. And I think, valuation, at least in the US market, are extremely high. The market, NASDAQ trading at 19% from a PE standpoint, so extremely high. We are also, seeing a lack of interest for the first time in treasury, and the government has had to purchase a lot of treasury. People are not aware of that, but more than 75% of U.S. treasury actually bought by the government or other government institution. So what would be your advice when you look at this global economic crisis and, valuation extremely high, you have a bond market that is really on the verge to explode? Where can investor safely invest in the next, let's say, 12 months?
Very good question. The first question, if you were sitting in front of me, I would say, Patrick, do you love your peace of mind, or do you want to have a sleepless night?
Let's assume that everybody loves peace of mind.
Yes. Patrick would say, Shan, I want my peace of mind. I don't want to lose funds. So I would say, Patrick, can you go back to 1970 and see what the investors did? And if you recall, last July, 31st July, Wall Street ran an article in 2022, how people fared during stagflation inflation. How did they protect their wealth during stagflation? So you and I, we both love real estate, because real estate is the new global currency. Equities can go down to zero. Bonds can go down to zero, but not your real estate, because you can go and touch the walls of your house. That is yours. So real estate has become the new global currency. Coming back to another asset class, which is gold and silver. 1971, gold prices were trading at $35 per ounce. 20th January 1980, gold was trading at $850 per ounce. That is 2,328% increase.
And we are above $2,000 though.
We are $2,000 now. And people have started talking about $10,000 and $50,000, which is very, very pragmatic and realistic. Look at oil. It is very much a tangible asset. 1973, oil was trading at $3 per barrel. And suddenly in 6 to 8 months' time, it was trading at $12 per barrel. 300% increase in less than 1 year. Can you get 300% increase in any asset class? I don't think so. I think investors, they need to go back to tangible assets. Real estate, gold, silver, cobalt, copper, nickel, because these are used in EV. EVs are the hot things right now. They need to go back to agriculture. You love coffee, you love rice, you love flour. So do I. Agriculture prices are going up because the weather patterns are changing. There has been an underinvestment in agriculture for the last 25 to 30 years. And the gap between supply and demand is getting wider and wider. Population is going up. Supplies are getting short. And you don't have enough supplies. And post-COVID, you have supply chain issues. Many people think the supply chain is part of the economy. I disagree with that. Supply chain is the economy. So supply chain is not part of the economy. Supply chain is the economy. People, they need to understand that during tough time, arts, luxury watches, the prices of arts go up 40 to 45% during tough time. And one currency that is coming up is Chinese yuan. 7 January 2011, I was standing in New York. There were 150, 200 investors, Intercontinental Hotel, Lower Manhattan. I was talking about Chinese yuan currency for the emerging market. People were making fun of me. And the feedback form that organizers showed, investors said Shan is mentally retarded and Shan is on drugs and Shan has got low IQ level and he is from Chicago Booth and he thinks that he's an upper class snob and he's very stupid. And the only person who gave me 7 out of 10 was my Nobel laureate professor, late Gary Becker, who flew down from Chicago to New York just to listen. So once I finished my presentation, I said I was under a lot of pressure today because someone who is very close to me, he's like a fatherly figure. He flew down from Chicago to New York and told my professor, come and see me in action. And I said, he's sitting right at the back. By that time, investors have already marked that Shan is mentally retarded and Shan has got low IQ level. And everybody turned around. It was my professor who gave me 7 out of 10. And I still remember over dinner, I asked my professor, what did you like about my presentation? He said 2 things. Your calm and the way you delivered your presentation. People were making fun of you. You remained a very calm composure and you did not get carried away with those, comments and when people were making fun of. So Chinese yuan is, a currency that investors, they need to look at. 30th November 2015, 4 years after I was talking about Chinese yuan is included in the elite basket of currencies called SDR with IMF. So investors, they need to understand that US dollar might depreciate again, like from 1976 to 1981, when Paul Volcker was there. US dollar depreciated 50%. And we have seen from September as of today, US dollar has depreciated 140 to 106. 8% it has depreciated. So once the Fed signals the market that we are not raising rates, we are cutting rates, I foresee US dollar going down further. And all the emerging market currencies, including Malaysian ringgit, Indonesian rupiah, Vietnamese dong, Thai baht, South African rand, all the other currencies, they will appreciate. So I think investors, they need to go back and understand what happened in 1970. And in order to protect their wealth, they need to take position in tangible assets so that they can have peace of mind, not sleepless night.
Yeah, I completely agree with you. I think that, China was always a sleeping giant. And if you look at what happened since 1980 on a track and check, I mean, at the time, you had more than 400 million people that didn't have electricity. Right now, China has experienced an incredible economic boom. China is certainly right now facing, on the real estate side, a market that you and I know very well, certain challenges in their secondary and in tertiary market where there has been an overbuild. And right now, GDP growth in China is around 3%. I think the concern in China is more, what is happening with a lot of the multinational global player moving out of the Chinese market. President Xi Jinping stating that, he really would like all Chinese to focus on consuming Chinese goods and not buying Mercedes-Benz, for example. So, I'm always someone who believes in open market and collaboration. And I think one of the real risk is that we see market closing in a push for nationalism, the U.S. market retracting, a lot of country nation doing the same and trying to focus on trying to solve their economic problem at a national level. I think, it is important to understand the impact of depreciation and devaluation of currency. It will happen across markets, certainly in the Eurozone that is already facing a deep recession. We are going to experience the same. I mean, the US dollar in terms of, valuation has already over the past 2 years and a half lost probably between 12 and 15%. And that's an estimate. So, you need to really look at the issue of purchasing power parity and how much, what $1 can bring you when you go to a supermarket. I mean, you look at the price of meat in the US, it has increased by 38%. If you look at the price of eggs, it has really doubled within 12 months. So the average consumer is really feeling the pain. And what we are seeing, the US market and everybody, most economists saying, the economy is actually doing well. Look, we have a GDP growth around 4.9, 4.4%. So as you said, we're talking about funny numbers because the reality in the US is that the GDP is really supported by a very strong consumption. And we are starting to see a slowdown in consumption because most people are, over leveraging the credit card. They move from 5, 6, 7 credit card companies are charging, 22, 25% rates. So we're going to see a lot of default on the credit card payment. We're going to see a lot of people who cannot make payments on their car. We are going to see people defaulting on their houses. So, the crisis here in the US could be quite dramatic. And that's the reason, because we are entering into an election year, that I think our current administration will continue to print money, which in the long term is not going to, improve the position of the dollar vis-a-vis the rest of other global currency. But it's always interesting to listen to what you have to say and bring a global perspective, because it seems that certain global market would be very interested for international investor and for American investor to diversify their portfolio.
Patrick, can I share something with you? You just mentioned about nationalism and protectionism. You're spot on. It is happening right now in front of our eyes. Many countries are making protectionism as part of the economic and trade policy, which is going to hurt the consumers in the end. You talked about how President Xi Jinping is encouraging domestic consumption and encouraging business. If you recall, Economist magazine, Patrick, August 2020, they ran a series of articles that what China is doing during COVID. So China adopted dual circulation strategy. What is dual circulation strategy? You support the local businesses and you encourage domestic consumption. In this way, your economy will continue to be in the growth momentum. Once your economy is in the growth momentum, it will generate interest from the local investors. Once it generates interest from the local investors, it will attract foreign investors into the market. So China continues, you rightly pointed out, China continues to have some challenges, and President Xi Jinping wants to have the dual circulation strategy to pursue for the next 2 to 3 years. As far as the GDP numbers in the US is concerned, there's a term that I've learned in 2050. It is called statistical illusion. So the numbers that Fed throws out in the market, I somehow feel they are like statistical illusion and not based on fact. But coming back to your point, a lot of investors, a lot of tourists are going back into US. 39% of the US household, they own US equity market. 9% of the US household, they own US Treasury bonds. So, the American investors, they continue to have this support for the equity and bond market. So I think for the next 6 to 12 months, as you pointed out, once the Fed goes back to QE fight, it will generate momentum for the equity markets, but it will again create inflation for the economy, and that will be a real headache for Fed and Jerome Powell. So I think we are in for very challenging times, and I would advise those investors who are listening to you that, go back to tangible assets and, see where they have made money. If they have made money in equities, stick to equities. If they had made money in bonds, stick to bond. Don't listen to Shan Saeed, don't listen to Patrick, because that's where you have done your homework. Suddenly you see Patrick is making money in bond market, but Patrick has done his research for the Fed. Shan Saeed is following gold market since 1999. So, follow where your risk appetite is. Follow where is your risk profile is. What is the rate expectation that you have? And above all, you need to have an exit strategy. You cannot sit on one asset class for the rest of your life. You need to have a plan. How do you strategize your asset portfolio? And you have to ask yourself 3 questions. What is my risk appetite? Am I moderate? Am I aggressive? What is my risk reward ratio? Do I need 6%? Do I need 25%? Nobody can give you 25% in this market. And most importantly, you need to ask yourself, when do I exit the market? Whether I want to exit the market in 10 years, 15 years. Real estate is 15 to 20 year cycle. Gold could be a 10-year cycle. Equities could be a 1 or 2 year cycle. Bond again could be a 2 to 3 year cycle. But every asset class has got cycles. And you need to have to ask yourself, what is my exit strategy? Thank you.
Yeah, absolutely. In the US on the real estate side, we see some sub-market doing extremely well. For example, storage, great demand for storage. Here in El Paso, where I reside, there's definitely a great deal for light industrial property investments, so warehousing. A Chinese company have moved to Mexico, and they are building a lot for, to have the ability to export into the US market. So regionally here, we've seen a great deal of demand for warehousing and other type of property investment. So I think everybody needs to do their research, as you clearly pointed out. Identify the type of strategy that you feel comfortable. It doesn't mean that the stock market will not be performing. There will be artificial intelligence stocks that are doing extremely well, drone technology, the defense industry. So I think you need to pick and choose what type of investment you're comfortable with, and also very, very importantly, as you pointed out, the time frame of your investment. Listen, Chad, I really appreciate your time. I know that you need to run because you have a couple of other meetings and you're just starting the day in Kuala Lumpur. But I wanted to tell you from this side of our show, we really appreciate your participation. We want to continue to leverage your knowledge of the market, and we're looking forward to our next program. But we are very humbled and grateful for your market insight, and more importantly, also the light that you brought on the global economy. Thank you so much, Shan.
It is my pleasure, Patrick. I'm also very grateful to you that you have given me an opportunity. I really enjoyed it. I was talking to my colleague. This program will go from Kuala Lumpur to El Paso, Texas, USA.
And many more places. We have viewers everywhere. We have viewers in Canada, in Europe. So, it's going to be a global program, which is what we want. Because nowadays, when you do investment, you really need to bring a global perspective. And that's the beauty of what you do and what I do. And we are absolutely privileged to have one of the most respected chief economists, covering the largest global brokerage real estate house in Malaysia to participate, and also in Canada. So absolutely a pleasure to have you, and looking forward to the next episode. In the meantime, if you like this show and appreciate the episode, you can, of course, continue to follow us and click on the like button. And we appreciate your time and confidence in our market knowledge. Bye-bye.